In 2021, a modest three-bedroom house in Boise, Idaho, saw 17 offers in one weekend. Meanwhile, a nearly identical property 200 miles away in another city sat on the market for 90 days with zero interest. Same house, same condition, completely different outcomes. What made the difference? One word: scarcity. And if you understand how to measure and leverage scarcity correctly, you can dramatically increase your chances of capital growth and strong rental income. Today, I'm going to show you exactly how. I spent nearly a decade as a property valuer with a degree in property and real estate, analyzing what makes properties increase in value. And here's what I learned. The properties that perform best aren't always the prettiest, the biggest, or even in the most famous cities. They're in markets where genuine scarcity exists. But here's the problem most investors face. They can't see scarcity. They're buying blind. Today, you're going to learn how supply scarcity works, why it matters more than almost any other factor, and most importantly, how to identify it using data at the zip code level before you invest a single dollar. Let's start with something you already understand. Imagine two concerts. Both feature the same artist, same set list, same experience. Concert A is at a venue with 5,000 seats. Concert B is at an intimate theater with only 500 seats. Which tickets are harder to get? Which ones cost more? Concert B, every time. That's scarcity in action. Now, real estate works exactly the same way, but with one critical difference. You can't always see the scarcity just by looking at a property. Two identical houses in different zip codes can have completely different scarcity profiles. And that scarcity profile is what determines your investment returns. When housing supply is limited and demand is strong, three things happen simultaneously. First, property prices appreciate faster because buyers compete for fewer available homes. Second, rental demand stays consistently high because renters also face limited options. Third, vacancy rates remain low, meaning your property generates income more reliably. This is why measuring supply and demand at the zip code level is absolutely critical. Citywide data won't tell you the full story. You need granular, localized data to identify where true scarcity exists. Now, not all scarcity is created equal. There are two types you need to understand: natural scarcity and manufactured scarcity. Natural scarcity occurs when there are genuine physical constraints on building new housing. Think about San Francisco. It's surrounded by water on three sides. There's literally nowhere left to build. Or consider mountain towns where geography limits development. These markets have built-in scarcity that isn't going away. But here's where it gets interesting. The more common and often more profitable type of scarcity is what I call regulatory scarcity. This happens when local zoning laws, building restrictions, or lengthy permit processes slow down new construction. Think of it like a restaurant with incredible food, but they can only serve 20 customers per night because they have a tiny kitchen. The demand is there. People want to eat there. But the supply can't keep up with demand because of operational constraints. In real estate, those operational constraints are often zoning laws and regulations. The key is identifying zip codes where demand is growing faster than new supply is being added. That's your sweet spot. That's where supply and demand data becomes your competitive advantage. When you can measure the gap between how many people want to live in an area versus how many homes are actually available or being built, you've found genuine investment opportunity. Let's talk about the income side of the equation, because scarcity doesn't just drive property values, it also drives rental income and stability. Imagine you own a coffee shop. In Town A, there are 10 coffee shops for 10,000 people. In Town B, there are only 3 coffee shops for 10,000 people. Where would your coffee shop have more consistent customers and better pricing power? Town B, obviously. The same principle applies to rental properties. In markets with housing scarcity, vacancy rates stay low because renters have fewer choices. When your property becomes available, you'll have multiple qualified applicants. This means less time without rental income, less negotiation on rent prices, and better quality tenants because you can be selective. Let me give you a real example. In a market with genuine scarcity, average vacancy rates might be 2 to 3%. In a market oversupplied with rental properties, you might see vacancy rates of 8 to 10% or higher. That difference might not sound dramatic, but let's do the math. On a property generating $3,000 per month in rent, an extra 6% vacancy means you're losing $1,800 per year in rental income. Over 10 years, that's $18,000, not including the opportunity cost of what you could have earned investing that money elsewhere. This is why supply and demand data at the zip code level is so powerful. It shows you not just where prices might rise, but where your rental income will be most stable and reliable. You're essentially measuring the strength of tenant demand before you buy. So, how do you actually identify scarcity? You can't just drive through a neighborhood and see it. You need to look at specific data points that reveal the supply and demand dynamics. First, look at months of housing supply. This metric tells you how long it would take to sell all the current inventory at the current sales pace. A balanced market typically has about 3 months of supply. Anything below 2 months indicates a scarcity situation. Below 2 months, that's extreme scarcity. Second, examine the building permit trends versus population growth. If a zip code is adding 1,000 new residents per year, but only issuing permits for 100 new housing units, you've got a supply shortage that's getting worse, not better. Third, analyze days on market. When homes sell quickly, we're talking under 30 days consistently, that signals strong demand against limited supply. But here's the important part. You need this data at the zip code level, not just citywide averages. I'll show you why this matters. Let's say you're looking at Austin, Texas. The citywide data might show a balanced market. But when you zoom into specific zip codes, you'll find some have extreme scarcity with under 1 month of supply, while others have oversupply with 9 months of inventory. Buying in the wrong zip code could mean the difference between strong appreciation and stagnant returns. Fourth, look at rental vacancy rates and absorption rates. Rental vacancy below 1.5% indicates strong rental demand. Absorption rate tells you how quickly new rental units get leased. Both metrics help you understand the rental income side of the scarcity equation. Here's a practical example. 2 zip codes in the same metro area. Zip code A shows 2 months of housing supply, declining building permits, median days on market of 18 days, and rental vacancy of 1%. Zip code B shows 7 months of supply, increasing building permits, 65 days on market, and rental vacancy of 5%. Which one has scarcity working in your favor? Zip code A, without question. That's where you're likely to see stronger price appreciation and more stable rental income. And you'd only know this by analyzing granular zip code level supply and demand data. Before we wrap up, I want to help you avoid the 3 most common mistakes investors make with scarcity. Mistake number 1, confusing temporary scarcity with sustainable scarcity. Just because a market is hot right now doesn't mean it will stay that way. Look at many markets during 2021 and 2022. Extreme scarcity driven by temporary factors like historically low interest rates and pandemic-related migration. When those factors reversed, so did the scarcity. You need to identify markets where scarcity is driven by structural factors, geography, regulations, job growth, not temporary market conditions. Mistake number 2, only looking at price appreciation. Some investors see rapid price growth and assume scarcity exists. But prices can rise for other reasons, including speculation. True scarcity shows up in multiple data points simultaneously. Low supply, strong demand, quick sales, low vacancy rates. Don't rely on any single metric. Mistake number 3, ignoring micro markets. This is the biggest one. An investor might read an article saying, Phoenix is a hot market and buy anywhere in Phoenix. But Phoenix has hundreds of zip codes with wildly different supply and demand dynamics. Some have genuine scarcity. Others are oversupplied. Some have strong job growth nearby. Others don't. Think of it like saying California has great weather. That's true for San Diego. It's not true for Redding. You need zip code level precision to make smart investment decisions. That's the only way to accurately measure and leverage scarcity. Let's bring this all together. Scarcity is one of the most powerful forces in real estate investing. When you buy in markets with genuine supply scarcity and strong demand, you position yourself for stronger capital growth and more reliable rental income. But you can't see scarcity by driving through neighborhoods or reading national headlines. You need data. Specifically, you need supply and demand metrics at the zip code level. Look for months of housing supply below 4 months. Compare building permits to population growth. Check days on market trends. Analyze rental vacancy rates. And most importantly, do this analysis at the zip code level, not just citywide. Remember, 2 identical houses in different zip codes can have completely different investment outcomes. The investor who understands scarcity and uses data to identify it will consistently outperform the investor who buys based on hunches, hot tips, or broad market trends. Scarcity isn't about luck. It's not about timing the market perfectly. It's about having the right data, understanding what it means, and making informed decisions that stack the odds in your favor. That's how you build long-term wealth through real estate investment. The properties that perform best tomorrow are in the markets with genuine scarcity today.